All right, my next guest says that she agrees with Secretary Bessent that there is a scope for an easing cycle. A terminal rate of 3.5% or so would make sense over the next few months. I want to bring in now Partners Group Managing Director, also Chief Investment Strategist for Private Wealth, Anastasia Amoroso. Again, congratulations on the new gig.
Thanks so much. It's great to
You've
be there.
always been one of my favorite on Wall Street. You're really, really sharp, and you push back. You're not afraid of going down the path yourself sometimes. You've been out there by yourself. You were out there initially, I think, on this tech trade by yourself for a long time, to be honest with you. Now everyone's on. It's like on any given day, 90% of our guests say, yeah, we like tech now.
Right.
I'm going to talk to you about that in a moment, but let's start with Bessent, right? Because he's been all over the airwaves, pushing. He made a comment about 150 basis points. I don't think he meant that one fell swoop. Nevertheless, that's how headlines interpreted it, right? This morning with that PPI number coming in much higher than anticipated, does that change the calculus at all?
No, I don't think so. I mean, it seems like the PPI number took the markets by surprise, but I don't really think it should have, because we've been hearing from companies in surveys that they are seeing input prices rise. They're seeing the prices paid rise, and at the same time, they're not yet passing through those increases. For example, prices received are not actually keeping up with the prices that they are paying. So what does this mean? That means that probably in the next few months, we will see some share of manufacturers see their margins squeezed, and to offset that, they will try to pass that on to the consumer. But first of all, I don't think it's all of the manufacturers. Right. For example, 75% of the respondents say they will do some sort of increase, and only a third of them say they'll do 100%. So this is why, Charles, I don't worry about it all that much from the rate cut perspective, because I don't think it's a direct 100% pass through of what we've seen in PPI to what we'll see in CPI.
And that would not be unusual. That's happened many times before, right? I mean, we've seen big divergences between PPI and CPI from time to time, and I'm not sure they could, even if they wanted to, pass as much.
Right.
You also, for your own investments, not as worried about tariffs, in part because of really limited direct equity exposure.
That's right. I mean, obviously, in the midst of April, we had to assess very carefully our tariff exposure, and we continue to do so. And the fact is, about 86% of our companies have very small or no tariff exposure, and some of it has to do with the fact that maybe they're domestically oriented. Maybe they're able to shift, certain products. So we do assess that as being very minimal exposure for us. And this is why, Charles, I generally continue to have a constructive view on the market, is because I think companies will take the adjustment this quarter. They'll do what they have to do. They'll announce to the market this is the hit from tariffs. But at the end of the day, it is a one-off hit. And I think we heard that from companies several times now.
Let me ask you about the capital markets, because I started the show. I talked about these extremely hot IPOs. Kind of caught a lot of folks flat-footed, but this is good, particularly for markets in general. You like it, but also for your business.
Well, absolutely. I mean, being in the private equity business, we always look at the exit environment and obviously pick up in transactions like IPOs, which is one way to exit from a company, or another way is through M&A activity. The pickup across both of those markets is very constructive. And let's just put some numbers around it. For example, the M&A volumes are up about 30% year over year. The global IPO volumes are up about 21%. Wow. So it feels like people think, well, maybe this has been a slow year for capital markets, but actually it hasn't, despite all the tariff uncertainty. But you're right. You're absolutely right, Charles. The fact that more and more IPOs are coming to the market is quite beneficial in our portfolios. And when I think about IPO performance, especially looking at some of the larger companies that IPO'd, meaning market cap above $1 billion, the average performance is up 50 or 60% since the IPO, depending on the day, depending on the company that you look at. So we're glad to see it. And I think we'll see more of this robustness as we progress through the fall, because, look, we have clarity on tariffs. We may not like the rate, but we have clarity on that. It seems like we're beginning to get clarity on the rate environment, which is also constructive. And we also have sort of a sense of clarity on the economy, that we're able to persevere, the consumer is able to persevere, corporates have enough margins to sort of absorb the cost. So I think all of that combined is giving the CEOs a lot more confidence.
And here comes the Fed, galloping ahead with their accommodation, coming with the punch bowl, which Wall Street loves all the time.
Well, we hope so. It also helps the cost of capital. So we'll look forward to that.
Anastasia, thank you very much.